A very good morning to you traders. Welcome to the new trading week, Monday 24th of March. We're nearly through Q1 and lots of events happening this week that we need to get over. Hope you all had a good weekend. I hope you're all looking forward to the week ahead. Let's get cracking with some of the news and headlines first. PBOC, they might have changed their rhetoric slightly in terms of monetary policy. For forever, they've been reiterating to implement moderately loose monetary policy. That's been their line for ages and ages. And there was a line out last week that they recommend increased intensity of monetary policy. We know they've been threatening to do rate cuts, including the RRR cut. None have come yet, but they're still banging that drum, it seems. So we still might get one dropping any time. So be prepared for an RRR cut, particularly if you're trading things like Aussie dollar in positions, because you can get a quick spike move in pairs like that or currencies like that. Data out today. It's PMI day around the globe. Australia with some really good numbers. Manufacturing PMI 52.6, up from the 50.4 previously. Services as well, up to 51.2 from 50.8. So good numbers coming in there. Japan, on the other hand, and what a time for that data to start going backwards a bit. Manufacturing has moved further into contraction, was expected to rise to 49.2, came in at 48.3. Services as well, moving from a healthy 53.7 to contraction at 49.5. So just when we've been seeing a decent run in Japan, we get this bit of a rug pull in that data. That comes after the Bank of Japan potentially open the door for a sooner hike, maybe April or May, from April or May. We could possibly get a hike that's a bit sooner than the sort of June and mid to latter part of the year when people have been expecting them to hike again. So anyway, that data going backwards in the flash number. Excuse me. Over in Europe, we've had the PMIs as well. France looking a bit crap still. They did see an improvement on manufacturing, but still in negative territory. Services, again, saw a little bit of an improvement, a bit more than expected, but we're still running pretty negative. Germany, looking again for that bit of optimism around the German fiscal spending. I don't think you can call 48.3 versus 47.1 expected optimism, but it was better nonetheless. However, the services went backwards. Was expected to rise to 52.3, came in at 50.2. So again, still showing or highlighting the issues in the German economy. Eurozone as a whole, pretty much similar type of move, a little bit softer in services and a little bit better in manufacturing, but overall no real massive changes there. The UK, pretty much the same, but the other way, saw big improvement in services to 53.2 from 51.2 expected and 51 prior, but manufacturing got much worse, was expected to improve, but went backwards. Manufacturing is the smaller part of the UK economy. Services number pretty good. Now, you might have noticed that the pound hasn't exactly ripped on those numbers. That's because the underlying details show that while there are, and there's the chief guy, Chris Williams I forgot who they are now. Market, that's who they are. As he said, there's only small pockets of improvement within that service industry. There's still a lot of uncertainty, a lot of worries amongst firms. There was some cost cutting to try and stoke business. So as much as the number looks good, the underlying details still paint a potentially worrying, uncertain picture. And that's probably why the pound hasn't gained too much on that, although it's looking a bit perky than it was first thing this morning. That's that morning data. Coming back to Japan, because we had some speakers out. BOJ Deputy Governor Uchida said they will continue raising interest rates if the likelihood of achieving their economic and price outlook rises. Governor Ueda was out as well, saying we'll adjust the degree of monetary easing if the 2% inflation target is likely to be achieved. Now, I might be missing something in interpretation or seeing something that's not there, but both of those comments sound like another subtle change of language, and we know they do this in very, very small steps and increments. Previously, the language has been that they would change monetary policy if their outcomes became realised. Now, this might be a subtle change that they will raise policy if it's likely they achieve their outlooks. Okay, so it's just another subtle shift, playing into the fact that we might be getting a hike sooner than maybe the market expects. So again, it might just be a little bit of interpretation, language, or whatever, but that's two of their members, the deputy governor and the governor, saying that if things are likely to be achieved rather than will be achieved. Over at the ECB, we've had the Dubs out. Stornoway says we might have had a terminal rate of 1.75 before the recent fiscal decisions, but now he expects them a neutral rate of around 2%, so he's hiking his expectations. On an April cut, he says everything points in the direction of a cut in April, but this is not April. Well done. He agrees that a rate cut in April could be considered the default option. It says tariffs should not distort our policy direction towards lower interest rates. The direction of monetary policy is clear to me, and we still have some way to go. Doesn't think terminal rate expectations of 1.5% are correct. Those are too extreme. ECB's Onion, aka Cipollone, also out saying that key element strengthens the case for further interest rate cuts. It said the inflation target may be reached sooner than last projections indicated. And the case to cut rates again has strengthened since the March meeting. So two doves fluttering their wings. Coming to, going back to the Bank of England, or the UK Bank of England, and after that PMI data, HSBC now see the bank cutting every quarter from September versus a cut at every meeting. So they've gone less dovish on their calls there for the Bank of England. A little bit of data out Friday in Canada. We had retail sales, which wasn't the greatest, shall we say. Headline sales coming in minus 0.6, worse than expected. Core retail sales, though, did show a little improvement at 0.2%. The flash projected sales for February coming in at minus 0.4%, so no improvement seen over the January numbers, according to that data. Back to the US, Chicago Fed's Goolsbeast says when you have a lot of uncertainty, you have to wait for things to clear up. There's been a decided turn towards anxiety and waiting on capital spending amongst business contacts. It says unemployment and inflation do reflect progress towards a dual mandate. The longer the Fed waits, it may mean the cuts have to be back-loaded. There can be a cost to waiting. It's him saying that if they don't continue with cuts, they may have to do more later on. Now, he says evidence is mixed on how sentiment influences activity, but contacts in his Midwest say that confidence is changing how they behave. Now, you know, I speak a lot about sentiment and confidence amongst firms and markets and how it drives activity. So he says the evidence is mixed, but then he gives evidence as to why confidence is changing how people react, firms and businesses react. Fitzwilliam says current monetary policy stance is entirely appropriate and growth is to slow in part due to lower immigration. I just want to highlight, we talk about some data points like the Michigan, you know, what it indicates. Is it a good, reliable indicator of things? It is what it is. And the same can be said for these US GDP nowcasts and GDP now things that a couple of Fed branches pull out. We've got the New York Fed GDP Nowcast predicting Q1 growth at 2.72%. That's up from the 2.69 previously. We've got the Atlanta Fed predicting minus 1.8% growth for Q1. So if you want to talk about surveys, data points, whatever, that show something, these are completely mixed and messed up. So take them with a pinch of salt, as we say. The main news over the weekend was that apparently Trump and his team are going to scale back their April 2nd tariff plan, according to the Wall Street Journal. Apparently they're just going to focus on targeted reciprocal levies and maybe bring some of the rates down as well. Obviously, sources piece, we might get Mr. Trump tweeting or truth bombing from the toilet. So don't be surprised if we get a reaction or a denial of that report at some point quite soon, because we all know that he likes to do so, and we know the press outlets that he likes to react against. So we've had a little bit of a risk boost this morning. Things like Aussie, pound, euro up on the potential lesser tariff threat, but all it takes is one truth bomb and we're back in the mire once more. We've got these ongoing talks in Saudi Arabia with Russia, Ukraine and the US. The Kremlin says on peace in Ukraine, there is a common understanding with the US on the willingness to move towards a settlement, but says there are still many different aspects related to a possible settlement in Ukraine that need to be worked out on talks with the US. And on these negotiations, they say they are underway on technical issues. So maybe we're not getting anything concrete from those. And we still don't know whether there's a ceasefire or not going on over there. There was another story out from the UK. Again, take this with a pinch of salt, given the source. But apparently King Charles has made an offer to the US and Trump to apparently make the US the next associate member of the Commonwealth. So not quite obviously of the Commonwealth, but a close member of the Commonwealth, to which Trump responded that it sounds good. So potentially we've got the terror threat still overhanging the UK, but we're probably not going to hit as hard, because things like aluminium and steel that have been tariffed already are not a big output from the UK. So it's not going to be massive to the economy, but we're making waves. There's a trade deal being worked upon, and this is another olive branch being offered. So that may be something that's positive for the quid as well further on. All right, that's all it from the headline front at the moment. Covered all the data and whatnot. We'll have a look at what's coming up this week. It's a fairly busy week. There's lots of things to pay attention to, particularly in the UK. So later on in the US, we've got the S&P Global Manufacturing Services PMI coming out, flash numbers from there. We get a bit more house price and housing data this week, new home sales tomorrow, and then the Case-Shiller FHFA house price indices. We get the consumer confidence number from the conference board, so we'll keep an eye on those inflation expectations once again. Also the German IFO survey, yet another survey to see if we getting any of that positivity, optimism from the German spending plan coming through. We didn't see much of that in the zoo or the PMI earlier today. Moving on to Wednesday, big numbers for the UK, if they can be believed, given our stats offices can't produce a cup of tea at the moment, let alone economic data. We've got CPI, PPI out. Wednesday is also this spring statement from the Chancellor that's going to be much watched by investors and the market. So this data will be out first. Might be a little bit of an indication, get the market moving as to whether it's good or bad in terms of what the Bank of England needs to do. That spring statement is roughly from probably around any time from 12:30 UK time up to 1 o'clock, I think, off the top of my head. It usually comes after Prime Minister's questions time, which can last sort of 30-40 minutes. So it'll be some time after that. Then later on in US, we get durable goods. Again, a little bit of an insight into the consumer, particularly if you look at the consumer durable goods rather than the big ticket items, to see if there's any data in that shows potential weakness of firms stocking up on those things like white goods and whatnot. On Thursday, we get I think it's the final US GDP number. So unless it's a big variation, we're just about to close off Q1. So that probably won't get much views. Pending home sales later on. Obviously keep an eye on jobless claims, see if we finally get something there. Friday, we get retail sales, or we get the start of inflation readings for March from Europe. So we get French CPI. These are all flash numbers, Spain and the likes too. We also get retail sales from the UK, which, given the mood the pound might be in after Reeves, could be decent numbers moving there. We are expecting a little pullback of minus 0.3% versus the positive 1.7% we got in January, but that was a rebound from a pretty crappy November and December. We also get GDP data again, final Q4 numbers there, but they may have a bit more focus if it's a big variation, again matching off against what Reeves has said previously. It will give an idea of the scale of the problem she's going to try and fix. Later on in the US, we get PCE and the old income and spending numbers. So that'll be our next inflationary read for that. And the final Michigan number, which was a bit of a wonky one, as we know, the other week in the flash number. So half decent data week, a few bits and pieces to keep us entertained on top of whatever stuff comes from his royal orangeness. We are in the month end week, and so we are probably going to see some month end flows. It is quarter end as well, so we're closing off Q1, so be in mind to see some potential price moves coming in at around the hourlies on the clock. Obviously the final month end is on Monday 31st, but we're going to have plenty of stuff going through probably this week, so keep an eye on those flows. If you see strange moves happening, as I say, particularly into the top of each hour, then you know it's likely going to be month end related, and the quarterly ones tend to be a bit bigger as well. So that's what we've got to look forward to this week, on top of everything else going on. Let's get stuck into what's been happening in prices. I'm going to start with the Aussie. Oh, no, not. If my button works, there we go. Which is looking a bit more positive today. I say that better data that we got overnight, giving a bit of a boost to the Aussie dollar as well, and also that tariff story helping things along as well with risk. So we've got potentially a half decent double bottom on the short term coming in just on this price action here. We got down to that 62, 50, 60 area, bounce from there. We're now holding the bottom of the zone. We're now broken back up through the top of the zone. So can we maintain it? Can we claw back what we lost from that move up towards 64 again? The fact that we can't seem to break and hold through 63 at the moment looks like it might already be struggling to make any gains back towards these sort of levels. So we're not out of the woods yet. We've had a little bit of a short-term bounce. We'll see if that's maintained. Obviously, if you get a truth bomb saying that WSJ story is a load of old crap, we're probably going to reverse a lot of this move. I'm still short in this one, Aussie Kiwi, and I'm keeping a close eye on it because we did, again, signs of a potential short-term double bottom down here twice. We've had a go into the low 109s, couldn't get through this 109, 10, 11 area, and we've bounced back. We got back above this more longer term 109.18 and held it on a test. Then we've broken back above all these more minor levels. 109.50 was quite a decent one, pointing back to these lows and beyond. We got above there. Let's bring it just into a shorter term for you. So we found resistance into there, but now we've broken it. We had these prior highs on the breakdown. We've broken those as well. Haven't just yet had a retest. We come, 4.5, 5 pips shy of it. So potentially can hold that, call that a bit of a hold of this, bit of a confirmation of this area. More needs to be done though. And we've bumped our head into this old 50 fib, which has become a bit of a level now to keep an eye on. So the fact again that this rally got some legs behind it, but we smashed into that and couldn't get through it, just shows you we're not quite ready to turn this trend around just yet from these highs. The 38.2 is 110.11, so it's just above the 110 figure. That's the main important number here. So for now, this is a bounce, but it's not a trend breaking bounce. But I have tightened up my stops now on my trade to just above this area here, 110.25, because I'm short from way above. So I said I'll do that if we've got to move down here, and now I think is the time to tighten those stops. So if it does break up, I'm not going to be giving too much back, and then I'll be flat, and then I can reassess the trade again if we move up to these highs. Euro dollar. A lot of people getting very short-term bearish on this. There's always people bearish on the euro, and it was looking very, very iffy towards the latter part of last week that we might be heading lower. But lo and behold, we ran into my next level under 108.30 at the figure 107.95. Bounce from there. We've got this intermediate short-term level at 108.15. Got back above there. We're holding that as support now. We've got back into the zone. We're trying to hold 108.30 now. So we're not dying a death just yet in the euro. Does it mean we're going all the way up to new highs? Not yet. It's got to do some work. We've got to get above 109 or 108.70. But we've also just again got this little intermediate area around the 60s, 58, 60s. We keep, finding support on dips and then resistance towards the 70. So all these little levels like this 108.15 are just popping up. So we need to get over those before thinking about the bigger levels. Still, this zone is going to be a decider for which way we go, and probably the next big move. Okay, so you either need to see it holding below 108.30, then you think about further downside, or holding above 108.70. But it needs to do a bit more than what it's done previously. We've got above, it's messed around. We've got above, got highs, came down, couldn't hold it. It's all a bit messy, okay? We want, or I want to see a good, decent day, couple of days, 3 days, 4 days, where we're holding either one side or the other. If we get that, then you can take your cues that the next direction is going to come from which side it is. But it needs the price to do its thing and build up more than what we've seen thus far. Okay, in the meanwhile, you can still trade it, even if you're holding above here and you don't get the highs, you might get some pips up to 109, maybe 109.30s. Same on the downside. There's still a chance that we break down and go and test this 107.60 that everyone has got their eyeballs on at the moment. Okay, but you need to get the evidence first for this one. As mentioned with the pound and Reeves, this is going to be a big watch this week. It's a big, big week for the quid. And I've been saying it all last week. I'm going to repeat it again. If you trade the pound, if you trade cable, if you trade any pound pair, you need to know the risk that's coming up. And I think you need to be careful if you're purely trading the pound rather than, other currencies like the dollar, then you need to pick your pairs. Because for something like cable, yes, we could get a big reaction based on what happens in the UK, but we've also got the risk of what happens in the US, Trump and everything else. So there's more two-sided risk for something like cable than there is for something like euro sterling, which is going to make it a bit easier potentially to trade it. For example, good news from Reeves, this rallies. Trump saying he's going to slap 50% tariffs on something, it's bad news. Okay. The same will happen for euro sterling, but if he's slapping tariffs on Europe and the UK, okay, you're going to see euro dollar cable moving, but you're probably not going to see euro sterling moving that much unless there's a speed difference. So think about, if you're trading a quid, what pairs you want to trade. Give yourself, or try and give yourself, an easier ride by picking pairs that aren't going to be affected on the other side. You can trade the pound, but not so much the other side. That's why I'm sticking with euro sterling for trading this event. Overall, I still feel that the balance of risks is tilted towards a lot of negativity this week. Now, that might be offset by positive data, it might be offset by what we get from the CPI data and what that means for the Bank of England, i.e. hot CPI, going to mean the Bank of England stay on hold for longer. That's positive for the pound. But for the Reeves thing, I'm not expecting the market to come away from this going, yay, we love her, everything's great, stick your money in the UK. Might happen, never rule it out, but my bias to this week is bearishness for that. So that's why I'm setting up. As for cable itself, yeah, we've had a bit of a climb back. It's in no man's land for me at the moment. We can't get through 130, so all the hard work of getting back up there again has got to happen again. And if things are positive through any items this week, but we can't get through that 130 level on a test, that's going to tell you all you need to know about that as well. If we do get through 130, it's got to hold it. Euro sterling. So we've seen a bit of a down move on that positivity from the PMI this morning. Not that it's lasted too long, but again, we're just stuck in this pretty tight range at the moment. And I think there's every chance for this one that if we get big news, we're going to be either somewhere down here or we're going to be somewhere up there. I'll be very surprised if come the close on Friday, we're still around about the same levels we are at the moment. It's a possibility. Okay, I'm not going to close my eyes to it, but I'll be very surprised if we are. So you may want to think, if you're not in anything now, sit on your hands and wait to see what the details are and what comes out. Right. I know it's Monday. I know you're all taking it easy, but if you've got anything you want me to look at, then be my guest. I'm going to look at gold before the usual suspects come and tell me off, because everyone likes to look at gold. Let me get rid of some of this stuff. I'll just showing someone else something. So boom, 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 boom. You know all about that stuff anyway. So gold's continuing its recovery. We're now back above the 30-20 and holding it. So again, positive vibes on this one. We're undoing this shakeout that we had. Levels are still the same, 30-38, 30-45, and then up against those highs there. If we get a hold at this 30-38 level up there, then that's potentially going to suggest that what it will do is it will strengthen these levels particularly. So that will be something that looks like we might have a more significant top than we've had in the last couple of weeks. So keep an eye on that level. If we're above there, then this is really a line in the sand. If we hold that 30-45, again, might signal that we've got a bit of a top forming. But if we go through there pretty easily, the chances are, if we take on those highs, then maybe we're going to break those highs. Depends on how strong this move continues. If it goes sideways a bit and gets a bit wishy-washy around the levels, it's going to look a bit undecided. But if we keep playing on today and we're through there and through there, every chance we're going on for new highs. In that case, I would look for a break of this 30-45 and then look for it to hold. If it starts holding, even if we haven't hit those highs, if we get through to 50, come back, test it and hold, that could be the springboard for then going on to new highs. And then we have to do the exercise all over again in terms of that. Surprisingly, or not surprisingly, depending on your viewpoint, stocks have staged a bit of a bounce. Futures opening, gapping up. Again, that was the Wall Street Journal story. So we've got a bit of a gap up in futures there, and we're looking good. We're back above the 57 mark. Fortunately for me, I was short this last week from 57.07. Unfortunately, it opened up around about where my stop was, rather than opening up massively above my stop. So I got stopped out at break even, or entry, I should say, on the rest of my shorts there. And it's kept this up move going. And I said last week, you know, we had a series of higher lows. We started to break that, but this was the key area, 5600, 5620s. That's why I stuck the yellow zone there, you remember from last week. We held that pretty much on the dot. And what this may do now is just extend, I'll just show you, let's do it that, where we, you know, potentially had an uptrend, you know, shallow uptrend there. We now might have one that's more, that's more wider. So we might have it coming in there against that. Okay, so we're still in the uptrend, but it just might extend the range of it somewhat. If you want to put straight lines in there, do so. But I'm just showing you what this move has potentially brought, as I say, just extending the potential range of this uptrend that we've been in. Get rid of those. Big level we've got up here, coming up, the 38.2 of this phased move here, 57.50. So keep an eye on that. It's the old 38.2 of another trend as well. Got a bit of traffic around this area as well. So that's going to be a bit of a decider as to whether we're going to take out more of this downtrend or whether this is potentially a bear flag forming. So take care of that one. Brand says bearish markets have the biggest rally. No, I don't agree with that, mate. You get things both sides. You say bearish markets have the biggest rally. Well, bullish markets have the biggest dip, you could say. Depends on the context. Don't worry about whether something's biggest or not biggest. Price action is going to tell you everything you need to know. Oops, let's get rid of that. Right, anything else, boys and girls? Or we might have a little early one. I'm not sure what else there is to show you. You can have a quick look at oil, I suppose, and then we'll have a quick look at yields just to get a bit of an idea what's going on. Again, a little uptrend is continuing in oil, getting back above this 68.80 level now. So we could be creeping up a bit. Looking like we're holding the 68 handle at the moment, and this is a continuous futures contract. So just bear that in mind when if you're comparing this to other oil markets and contracts that you may be trading. But either way, we are holding this uptrend, so things are looking a little bit more bullish at the moment. Keep an eye on that PMI later in the US. If we get a decent improvement in manufacturing, particularly on that side, could mean a little bit more of a boost for oil there. Otherwise, we're still playing the same old games with that one. Quick look at yields, US 10s, coming off that 420 level, still getting a little bit of a gap up on that positivity. So a little bit of risk reduction on the tariff stuff going on there. 434, 35, 33s still remains the big area to look at for that one. And keep an eye on UK yields this week as well, what with Reeve stuff coming this week, because also we're getting revised or latest forecasts from the Office of Bodged Responsibility. There are fiscal watchdog. Growth is expected, forecast expected to be halved or up to halved this week, which won't be good for stuff. And obviously, the higher yields go, the more fiscal headroom that eats into for the Chancellor. Just makes things a bit tougher for her as well. So if you want to be trading the quid again, just keep your eyes on gilt as well. We've got a couple of gilt auctions coming, which could be a bit wobbly also, depending on what Reeves has doshed out. So you need at least 5 eyeballs for trading the quid this week. So make sure you know exactly what could move markets. Dollar MEX, Michael, most certainly. I'm still short this one. Again, tightening up my stops. I'm short from up near this 21s. I've got rid of my lower entries on the way up. So I'm just sitting in my higher entries, a little bit left on that. This bounced pretty decent, and as I've been saying, I thought it was going to struggle to hold below the 20 figure, particularly as the clock ticked down to this tariff round. So again, we've seen this coming down a little bit. Maybe on that tariff news, things won't be as bad, but not as much as expected. Half the market is seeing a bit of positivity. The other half, who look at MEX, Canada in particular, because they've been in the crosshairs, perhaps thinking that we're going to get some noise here as well. We got close to this 20, 28, 29 area. Couldn't get through it. We've had a little bit of a pullback. For me, all bets are off in terms of where this goes until we get clarity on this tariff stuff. I wouldn't be surprised if we see spikes up 2050s, maybe up to the old 2080s at the most. But as I've been saying, bear in mind, we've had big moves and then we've had lesser moves on the same news. So we'll see if we're going to stay in the zone, test the top of the zone, or whatever. Depending on the mood, I would potentially be interested in adding back into these highs if seen again, but depending on the news, we're getting up there. Michael, what are you in? Short, long? What are you doing, my friends? Let me know. Ali, you think 130 is coming and a break of 130 is coming? Your gut feeling, okay, mate? As long as you trade the price action, not your gut feeling, you'll be fine and dandy. Right, let's call it a day. I like a nice easy one on a Monday. You lot can go through everything we've spoken about and get your plans ready, get your levels ready, get ready for a big trading week. Well, I'll see you in a bit in face. Otherwise, have a great day, have a great week, and we'll catch you tomorrow. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.